Banks are in big trouble. The Federal Reserve may have just cut interest rates by 50 basis points, however, it is beginning to look like this could be too little too late. Consumer weakness is getting worse and worse by the day, and this is starting to hit banks where it hurts in a number of ways, including loan delinquencies. And the problem has now become so widespread that many global banks are now coming out with public warnings themselves, addressing investors on what may be about to happen. So the current consumer landscape is looking pretty dismal, however it is looking like we could be seeing one last hurrah before purchasing power cracks for good, as credit card debt has just unexpectedly soared. Total consumer credit in July did reverse the June slowdown, surging by more than $25 billion to a new record high of $5.093 trillion. And with this, we've seen credit card debt specifically surge to $1.359 trillion, which is a new all-time high, while at the same time, the personal savings rate has plummeted to just 2.9%, close to all-time lows. The excess savings that many people had built up during the pandemic have now been depleted, and it seems like a number of these people became so adjusted to a certain lifestyle and level of spending that they have now resorted to using credit cards to rack up more and more debt in order to keep up. Many Americans are being crippled by these monthly interest payments on all of this debt, as the average credit card debt interest rate just hit a new all-time high of 22.76%. Consumer credit rates tend to be extremely sticky on the way up, but slow to decline on the way down, meaning that even when we do start to see the Fed cut rates, we won't see consumers see much of a benefit from this anytime soon. Now, this consumer data does line up with the message that we have been hearing from many retailers, including Dollar General, who saw their share price plummet 26% after catastrophic earnings, missing both profit and revenue expectations. Dollar General also slashed their future guidance outlook, warning that core customers feel financially constrained. And similarly, another discount retail giant in Dollar Tree also saw their shares plunge 12% after falling short of estimates in their earnings, slashing their full-year outlook too. And Dollar Tree did also warn that the macroeconomic environment is causing mounting financial pressures on middle-income and higher-income customers. And it was only a couple of months ago when we saw major companies like Nike, McDonald's and Airbnb that act as a barometer to the general health of the consumer all report disappointing earnings with weakening outlooks. And in fact, McDonald's have opted to extend their $5 meal deal promotion, which was originally just a summer promotion, until December across the whole of the US due to their core customers being under pressure. We've also just seen reports coming out suggesting that demand for Apple's new iPhone 16 is lower than expected, down 12% from last year's first weekend sales of the iPhone 15, largely being driven by weaker demand in the more expensive Pro models. All of these very similar warning messages that are now being given out by these multi-billion-dollar publicly traded companies does paint a very clear picture on how weak consumers are right now, with things only likely to get worse. The Restaurant Performance Index, which does track the health of the restaurant industry in terms of sales, traffic and overall business conditions, is an indicator that does also back up this message as well. It has now fallen to new lows not seen since 2021, where there was a lot of pandemic fear and not that many people were able or willing to go out to restaurants, levels that are only really seen during recessions. Now, a lot of these troubles that consumers are facing today are a result of higher prices driven by recent inflation, as well as the higher cost of borrowing from the current high interest rates. And now, Jamie Dimon, the CEO of JP Morgan, is warning that the US is facing an economic fate worse than a recession, stagflation, which he does call the worst outcome. Now, stagflation is when a country does suffer from a stagnation in economic growth while also suffering from inflation, leading to rising unemployment. With all of this consumer data coming out that we've just looked at, it certainly does look like the US economy is not only slowing down, but heading towards recession territory. Jamie Dimon does say he is worried about a raft of inflationary forces that are on the horizon, such as higher budget deficits and increased infrastructure spending, which is going to continue adding pressure to an economy that is still reeling from the impact of high interest rates. Now, this new warning from Dimon does come after his previous warning of an economic slowdown back in August, where he said he believes the odds of a soft landing were around 35 to 40%, with a recession being the more likely outcome. Now, being the CEO of the largest US and global bank certainly does mean that Jamie Dimon is a credible voice, as he does have his finger on the pulse with the data that he is seeing. And in fact, JP Morgan themselves are dialing back on their own performance expectations due to the current economic conditions, lowering their expectations for next year's net interest income, the difference between what banks earn on their assets and what they pay on their debts. And JP Morgan President Daniel Pinto has told analysts that they're being too optimistic, even calling analysts' current net interest income estimates not very reasonable. Now, Pinto did also say that third quarter investment banking fees could rise 15%, while market revenue could rise 2%, which are both below what analysts had been anticipating. For months, JP Morgan CEO Jamie Dimon has been cautioning shareholders that the firm is over-earning amid tailwinds that wouldn't last forever. But JP Morgan is far from the only bank or financial institution that is feeling pain right now in this economy, as we've recently just seen lots of concerning data coming out from a number of other institutions. Major auto lender Ally Financial has just warned that consumer credit metrics are deteriorating at the Barclays 22nd Annual Global Financial Services Conference. Their CFO, Russ Hutchinson, highlighted that July and August saw delinquencies soar a whopping 20 basis points compared to their expectation, while net charge-offs were up around 10 basis points compared to their expectations. Hutchinson did say, "We're clearly dealing with a cohort of borrowers who have been struggling with the cost of living and now are struggling with an employment picture that's worsened." He then added, "As that pool of struggling borrowers in those late-stage delinquency buckets has grown, it gives us pause." And Hutchinson did state that Ally Financial may experience some underperformance, and they are evaluating if they need to increase their reserves to cover bad loans if needed. And another one of the banking big dogs, Goldman Sachs, has also issued a caution to their investors, with the bank's CEO, David Solomon, warning that the trading unit is on track to drop 10% from the prior year, led by declines in the fixed income business. Goldman Sachs is also set to take a $400 million pre-tax hit in its narrowing consumer business as it moves away from its credit card tie-up with General Motors and its seller financing business. In total, Goldman Sachs has lost a staggering $6 billion pre-tax since the beginning of 2020 on a big chunk of its consumer lending business, including its credit cards. And in fact, Goldman Sachs now has the second worst credit card portfolio of all US banks, only behind Ally Bank that we have just discussed, with a whopping 25.4% of their loan balances projected to be written off as losses. And analysts had expected a 6.6% decline in its trading unit this quarter, but Solomon did telegraph a bigger drop. And on top of all of this going on in the banking sector right now, we are also seeing Berkshire Hathaway continue to unload more Bank of America shares, now bringing their total sales to $7 billion since mid-July. Deutsche Bank are also unloading $1 billion in US commercial real estate loans after taking heavy losses in their real estate portfolio in a bid to unlock some capital relief, according to people who are familiar with the matter. We know that banks collectively have suffered huge unrealized losses in recent years due to interest rates surging in such a short space of time, and many of these losses are coming from the commercial real estate sector. Now, the problems the US are facing extends well beyond the current consumer and banking landscape, as the national debt situation has reached a tipping point whereby the US government literally cannot pay back its debt, causing a whole load of new problems to come further down the line. My previous video goes into more detail on this topic, and you can check it out by clicking on screen right now. Aside from that, if you did enjoy the video, please be sure to leave a like and subscribe, as that does help out the channel a lot, and thanks a lot for watching.